Hello, welcome to this video tutorial. I'm gonna be showing you here how to trade the market structure. Previously, I did a lesson on how to mark or draw the market structure, identifying the highs and the lows of structure. So this video will be how to trade the market structure. So let's get on with it. So how you draw the market structure, still the same. So you know that for short-term high, you need a candle with a higher high on the left. On the left of that candle, there should be a candle with a lower high, right? And then a candle with a lower high also on the right. And then as a confirmation of that high, we need price to go through the low of that middle candle. So those are the basic of the market structure. Remember, so nothing has changed on that. So this is how you still find short-term high, and then the short-term low will be the opposite of that. It will be the candle with the lower low, higher low on the left, and higher low on the right of that candle. And then price has to trade through, not necessarily close above, but trade through the high of that candle with the lower low. Then we know that this would be short-term low, and then this would be short-term high. So this is how you find your short-term high and your short-term low. So nothing has changed on that. And then we know that for a swing high, when we have this, so let me just add candles here. So let's say here you have another line. Short-term high here. Short-term line on the right. So when we have this is a short-term high, and a short-term high here. Okay. And then of course this would be a low. So we know that whenever we have short-term high, we have this pattern here. So this gives us a swing high. So that means this short-term high that is higher than the one on the left and higher than the one on the right. It becomes a swing high. Okay. So nothing has changed on that. So the way you know the market structure, how to draw the market structure, still the same. Okay. And will not change. So what is important now on this video, I'll be showing you how to trade the market structure, because it's one thing to be able to mark the structure, find the highs and lows, and then it's another to be able to take advantage of the structure or be able to trade the structure. So structure by itself is tradable. Okay. And this is what I'll be showing you how we will be doing it this year. Okay. All right, so let's look at the chart here. And then I want to show you something that is very important here. Again, simple and yet powerful. So let's do structure. So let me simply put on there, those bars there. So let me just take it here. And then I'll do this. I'm just doing what? Short-term structure. Hmm. So we have hello. This was not followed by a low, so it cannot be. Because remember, a high has to be followed by a low, and a low here. It's like that. So let's see here. So here we are just focusing on the highs and lows. It's no to mark our structure. None of this has changed. So it's something that you already know what to do. You should be acquainted with it already. Your eyes should be used to seeing this. Let me stop here. So this is the short term on the 5 minute 15 minute here, and then can simply hide this. Like so. So we have our bars there hidden, right? So this is pure structure as is given to us by the market. Okay. So now we just need what that pattern that we know that this is a swing high. Why is it a swing high? Because it's a short-term high with a higher high and lower high on highs on either side of it. And then this would be a swing low. This would have been a swing high, but it's not followed by a swing low. So we have a swing high there, and then we have a swing low. And then we get swing high up there, and a low, high, yeah. Most relatively equal there. We have a low here. Here we have a high there. Then we got a low over there. So this is what we have, right? And this gives us um, our swing structure. Which is what we want to work with. This is our 15-minute swing structure, which is what we will refer to as our market structure. Yeah, we're gonna trade the short term, the fractal structure, or the primary structure. We're going to trade our main one, which is the swing structure. So I just want to change the color on the fractal one. Okay. So so the fractal leads us to the swing structure. So this is what you know, guys. You know this already. So what am I going to show you today with this? Let's look at this in more details. So when it comes to market structure, there are there there are people who focus on the highs and lows, which is us, as we do. But there's also a group of people that will work with the line chart instead of the candle. So this would be their structure. Okay. And then sometimes where they have break, we don't have a break of structure. Sometimes where we do have break, they do not have break of structure, so on and so forth. So, well, let me show you what we're gonna be doing here. So the line chart focuses on the candle closes. Okay. So we are going to incorporate the candle closes when we mark our highs and lows of structure. So we're gonna take the high. If we are marking a high, we're going to take the wick and the highest body there, because the highest body would be the high of the line chart. So we are combining the two school of thought. And then when we are marking the low, we're going to be taking the lowest wick and the lowest body close that we see there. Okay. So you'll see how accurate that makes the structure to be when we combine the two. Okay. So in combining the two, we don't necessarily need to be looking at the line chart. We can do everything looking at our normal candlesticks. Okay. So let me show you this here. So whenever you get a high, which is a swing point that you're going to be focusing on, you want to mark that high not as a level. So don't mark it as a level like this. Okay. You mark it as a level like this, but rather we are going to mark it as a zone. So you take the wick and the highest wick and the highest body close. like this. So you'll see why is that important as we continue. So this is how we're going to be making our market structure zones. So this is a swing high zone. So market structure has its own zones. Okay. And this is the best way to trade the market structure with its zones, not other foreign stuff. So we have here the high of structure instead of just marking a level. And then when we mark the low as well, we first need it to be a swing. We need a swing point, okay? So we're going to be marking the lowest wick and the lowest body close, which would be this one here. So this is how we mark our low of structure as a zone. Okay. And then these zones are going to be used are used as support and resistance. Okay. These zones, structure zones. Okay. Why am I calling them structure zones? Because the zone comes from the way we do structure and the line chart. So they are born of the two school of thoughts or two structures, the external or outer structure and the inner structure. Outer structure being the one that focuses on the highs and lows, and then inner structure being the one that focuses on body closes. So you see, we have a high of this structure, the line chart, it's a high here. As price went down here and broke a low. So that became a high. And then for us, this became a high as a swing point because there's lower high on the left and lower high on the right, short-term lows, like this one. See, we have a lower high on the left and a lower high on the right. So that's how we established it as a high. So on both outer structure, which will focus on the highs and lows, and then the inner structure which focuses on body closes, which is the line chart, we have that zone. Again, the same here. Look at this. We bring in the line chart. Actually, the lowest body close is here. Okay, so when we mark this, we want to consider things like that. Okay, so that this is not, according to the line chart here, is not the lowest body close as we would have just took that candle here. The line chart, according to line chart, if you bring in the line chart, you must say this is the lowest point, but this would be the lowest point. So we can mark this zone like this. We are taking the lowest body close as much as here we are taking the lowest wick. So we combine the two like that, and then that's how we get the zone, right? But for basics, you can still mark it like this, but you have to be, because just this one just makes, it doesn't make the zone wrong, it just makes it bigger. And then this one makes it what? Smaller. So with the bigger one here, one would have anticipated or took advantage here, for instance, for a buy. But if you made it this small, you wouldn't have gotten the chance to get in there. However, you could have gotten down here where actually the market started moving aggressively, but you would have missed out on the opportunity to buy here. So still fine to mark it like this, because what is important is that even if we look at the line chart, we could stretch this like this. This is accommodated. It's not like it's neglected in a sense that we will not be using it. See what I mean? It's just that it makes our zones to be small. Okay, so we just mark the lowest wick and the lowest candle body close. You can look at the short term, where the short term low is forming, so that you will not be confused. You don't necessarily need to put it back there, so it can just focus on that. As long as you have the lowest wick, the body will just determine how big that candle or the zone gets. It will not disadvantage us for identifying when the market breaks, when the structure breaks. So that's how we mark the highs and lows of the market structure. Okay, so that means here, when we're marking that high, we'll take what? The highest wick and the highest body close. So that allows us to do what? To accommodate both school of thoughts, and combining them like that, it becomes more accurate. Okay, becomes a more accurate way to look at market structure, the breaks and stuff like that. Okay, so you'll see why zones are so important and not just a line. Okay, so that's how you mark that high, and then marking this low. This, it will be the lowest body close, not the open. It's the open. The close is here, and the lowest wick over there. So this will be the low. Okay, so this is how we mark them. Right, so here our markings would be like looking at that as a swing point. We'll say, okay, the highest body close would be this one there, okay, and then the highest wick. But in the same light, just like what I showed you here, even if, let's say, you did not take that one, you just focused on where we had a short-term high forming here, we put on the zone. Okay. We'll make the zone a little bit bigger, but the thing is that it does not disadvantage us at the highs. Okay, so we can mark our zone like that. So here we have this one. This is our zone. And then as price goes up, you see it's a swing point. Whenever we have swing points, we look for the lowest, highest, body close, and the highest. So highest week. So we have that over there. And then here, this will be your zone. It can get big. It's a big problem. You have that. That's it. It will be a zone. That's how you mark your zone there. And then here you mark it like this. And then that one, see, it's very tiny. It's a very small zone, almost making just a line. So that would be on zone. So that's how we mark our market structure zones, allowing us marking highs and lows like this as zones instead of levels like a single line. They allow us to recognize both school of thoughts, the higher high, the highs and lows, and what it closes. So that's a better way to mark the highs and lows of structure. So you mark a high or a low of structure as a zone, not as a single level.